If you're still struggling with market structure, then this is the exact video that you need for all of your doubts to become clear. Essentially, we're going to be looking into the most important parts of structure: how to identify structure, how to use the premium and discount model, how to use the 3 different types of structure that you've probably never heard of before, and how to combine everything to get into a profitable position. Without further ado, let's kick it off with simple market structure. Now, I know you've heard this already, but it's very, very important concept. It's something that we have to dig deep into. So as we look on the chart right now, essentially what you'll see is me mapping out my ideological swing structure points. You can see that we're in a bearish trend, making highs, lows, lower high, lower low, lower high, lower low, and then we have a change of character, making a higher high. So essentially we have bearish swing structure, bearish price action, and then eventually at some point price shifts to go bullish. And of course, at that point in which we go bullish, that is what we refer to as our change of character. The change of character is a very, very valuable concept. It essentially indicates to us the shift in trend. And essentially once you get that change of character, or let's say hypothetically price looks how it is right now, what do you think you're expecting? You're expecting price after making a higher high, putting in a higher low, to then go ahead and put in a new higher high. And considering it is our job as a trader to be able to understand where the market is heading before the market gets there, this gives us an insane edge over the market. Now, that's basic. Let's go and take a look at something that is a little bit more advanced, but also more realistic. Now, it might look a little bit complicated, but I'm going to simplify it very easily. Essentially, what we're going to do is we're going to map out our swing points in structure first, and we're going to map those out in red. So essentially, swing structure is understood as the external swing points in structure that cause price to have a reversal. So if we see here, price puts in a low, and then it has this pullback. Notice though how that pullback is in reality inside of the previous price leg. We have our high and we have our low. That's what we refer to as our trading range. Anything inside of that is simply internal until we get to the edge of price before we then go and put in a new lower low. And then again, you see we now have a new swing structure. We've just put in a lower high and then put in a lower low. So essentially we now have a new trading range. We have high and we have lower low. So we went from high, low, lower high, lower low, price pulls back up. This is the highest point that price puts up before then going and putting in another lower low. So you can see how we're able to identify our swing structure like so. And then from there, what you see is price pulls back. You're likely expecting some sort of respect of this high and then putting in a new lower low. However, in the case in which a change of character occurs, that is unlikely to happen. So what happens is the change of character takes place and we shift from bearish price action to bullish price action with a change of character. Now, the thesis stays the same. It's just in opposition. Now we're bullish instead of bearish, but still we have our swing low, we have our swing high. Price is now trading inside that range until it breaks out of that range. But what you're expecting, the expectational order flow, is that price will pull back somewhere along this price leg and then go and put in a higher high. And so essentially we're looking at price puts in a higher high, has a pullback, and then goes and puts in a higher high again. Now notice that right now we don't know that price is making its way up here. Price hasn't yet made its way up there, but we know that price is making its way up there. So that is the discrepancy on edge. We understand that price is heading here before price actually heads there. And I'm going to now give you some more insight into exactly how it is that we're able to understand that. First, we're going to take a look at the premium and discount model, which is a very, very simple concept. Imagine for a second, if we go back up to the basic market structure, imagine for a second that each price leg, you draw a fib level. So, okay, let's say price breaks structure. So we have right here a break of structure to the downside, and we understand that price is bearish. So what you would do is you would take the high and the low and you would draw out your fib. And what you want to do is go into your settings on your fib, like so. And then essentially if you don't have it already set out or you have the basic fib levels, what you want to do is come into style here. And then you want to unselect everything that's selected and only select 0, 0.5, and 1. And then you can, of course, color code them however you wish to in alignment with your already color coded charts. So the idea behind this is a super simple one. Let's say the top half of a price leg, right? So we have the 0, the 1, and the 0.5. The top half is what we call premium, right? And the bottom half is what we call discount. Now, it's super simple. The concept is that you want to sell in a premium and buy in a discount. And what you can do is you can just refer to that concept as standard economics. I mean, when you're selling something, you want to be selling whatever that is at a premium, right? Let's say you have an asset. You want to be selling that asset whilst it's at a premium. And if you're buying an asset, you want to be buying that asset at a discount. Everybody wants to buy things at a discount, right? So it's a simple concept. We just break the price leg into two legs. We have a bottom half, we have a top half. The top half is called premium. The bottom half is called discount. We want to be shorting in the premium and longing in the discount for the most part. Now, what you will find is 70% of the time, more or less, price will retrace to at least 50% of a price leg pullback, meaning that 70% of the time, after price puts in a lower low, it will pull back above the 50% level. And when price goes and puts in a higher high, like it does right now, pulls lower low, goes, puts higher high, and we just draw a fib out right here, what we see then is we're expecting price that it's very likely that price will pull back into this premium, into this discount area, of this price leg. And it's in the discount ideally that we would get our A+ setup, and that's where the premium is. So when price gets into a premium, that's essentially when supply comes in. When price gets into discount, that's typically when demand comes in. So that's the concept of discount and premium, which we're going to use in more depth in a moment. Now I want to go over the 3 different types of structure, because this is a very, very valuable phenomenon that more than likely you haven't heard of before, because I haven't shared it before. And it's a super valuable thing that we use here at Prosperity Academy. So, in an ideal world, your price looks like this, right? You just have a low, a high, a lower low, a lower high, a lower low, changes character, pulls back. But what about everything that happens in between that, typically speaking, throws everybody off? They're not understanding what is a high, what is a low, what's a swing point, what's not a swing point. This is where I'm going to clear that up for you. So quite simply, let's color code things. Let's take our red as our swing structure. So we've got red, and we're going to map this out as swing. That's our one type of structure. Now, the swing structure is the external points where market reaches to before reversing. And so if you look, you'll see that market comes down from here, it bottoms out, it reverses from here, it comes up here, it tops out up here, and then it reverses, comes down here, it bottoms out, reverses, comes up, tops out, reverses, comes down, bottoms out, reverses, puts in the highest point comes down, reverses. And then if we go and put a new high here, this will be our new swing point. So swing structure is a simple concept to understand. Now we're going to go and take a look in the second type of structure. And we're going to color code our second type of structure in purple. Now, our second type of structure is what we call order flow, right? Order flow. And the way I see order flow and the concept of order flow is it's the present moment flow of orders. So swing structure can vary. It can take a whole day to put in a new swing leg, 2 days, 3 hours. It doesn't matter. But order flow is your present moment price action, the present moment direction. And so what we understand is our order flow is another word, again, which we can use for internal structure. So you have your external, which is your swing. But then what happens is, as price comes inside of the price leg, you can see right here, price puts in a high, lower high, higher low, higher high, higher low, higher high. Notice that internal structure is actually putting in a series of higher highs and higher lows at this present moment, meaning that the present flow of orders in this market are actually demand orders, and they're actually increasing price up. So essentially, at the present moment, there is a more bullish sentiment than anything, meaning at this present moment, there are more buyers than there are sellers. That's why price is increasing, right? Simple concept. Now, again, let's ignore this. Again, price puts in a lower low. Then what happens? Price puts in a high, higher low, and higher high. Then price pulls back. Price puts in a high, higher low, higher high, higher low, higher high. Notice that all of these points that I'm referring to as order flow are actually the pullback phase of the swing leg. It's essentially where in a bearish swing structure, you have bullish internal structure, which we refer to as order flow, because that is the present moment sentiment for price to, usually, typically speaking, pull back into at least 50% of the price leg. So we use order flow to understand the present flow of orders, and we use order flow to understand the sentiment inside of a price leg. And then our third type of structure, which we're going to map out right here in green, is going to be our order flow realignment. Our order flow realignment. And for simple, I just call it OFR, order flow realignment, right? Now, our order flow realignment is an amazing phenomenon, spelling error there, because what our order flow realignment does is it gives us the insight into where price swing structure is going before it actually gets there. So if we look right now, we see our swing structure is bearish, right? We've put in a, let's say, for example, we've put in a lower low. It was a break of structure here. So we put in a lower low, then order flow comes in, low, higher low, higher high, higher low, higher high. And then what happens is order flow realigns itself with swing structure, meaning that the swing structure is bearish and momentarily the order flow is bullish as swing structure is having a pullback. And then the internal structure shifts bearish. That is, of course, an internal change of character. And that right there is our order flow realignment, because the order flow has now realigned itself with the swing structure. And so in theory, what that means is that when that happens, and again, that happens at this point right here, our order flow, our swing structure is already bearish, right? We've already let's say we've had a break of structure in here. So we're already bearish. Now we've pulled back. Now this order flow realignment right here is our value discrepancy between where price is and where price is heading, because we are now able to make the conclusion that price is heading toward this low before it's even there. And again, our only job as a trader is to understand where price is going before it gets there and then get involved. That is how you are a profitable trader. And so this is essentially one of the main methods that we understand how to get our edge over the market. It's understanding that at this point right here, once this internal change of character happens, so order flow realigns with the swing structure, once this happens, we now come to the conclusion that this low is going to be taken out. And, a decent portion of the time we're going to be right. And a decent portion of the time we're going to be able to make money off of that value discrepancy. So that is essentially how you gain your edge. It's understanding that price is heading to this level, and we know that before price even heads there. That is the whole point of an edge. So what happens is we change character, and then the order flow realigns. So we have our order flow realignment, then price puts in a lower low, lower high, and then lower low. And at that point, we've had our external break of structure right here. And again, we're going to go and take a look at all of this on the charts in a moment. So our external break of structure, then what do we have? Well, we have our order flow comes back in because it makes a high, higher low, higher high, like so. That essentially is the pullback phase of the swing structure. So price pulls back at least into 50%. And then what you'll notice is that order flow realignment right now is actually the same as the swing leg. Now, this can happen, and this is why I purposely created the graph like this, is because not every single time will there always be internal structure in an external structure leg, because sometimes price can move so aggressively into one side that there is no pullbacks inside of that price leg. In fact, price just melts straight down, which we'll see an example of when we get into the charts in a moment. So I wanted to put that in there, but still understanding the concept of, as price takes out this low right here, as order flow shifts from bullish to bearish, we already know that this low is getting taken. So it's still, we know early, but there was just no opportunity to get involved in the market. And then what happens? Price puts in a new lower low externally. So we have a new swing lower low, break of structure to the downside. And then our order flow, again, if we shift this back to purple, our order flow puts in high, higher low, higher high, higher low, higher high. Now, in doing so, essentially this is order flow because at the moment we're still bearish. So we're expecting bullish, and then at some point price will shift bearish and we'll go lower low. Now, out of a trend, right? Let's say we have a trend, and that trend is making a series of lower lows and lower highs. Now, typically speaking, the change of character is completely unpredictable, meaning you can predict the next lower low, you can predict the next lower high, you can predict the next lower low, but you can never predict going from a lower low to a higher high. You can't predict it. We can only understand a trend. Until that trend changes, change of character, we can't understand it or anticipate or plan for that happening. Now, luckily, that only happens, 20% of the time where we shift from bearish to bullish, and that 20% of the time is unpredictable. But for the most part, you can see we expected a lower low, we got it. We expected a lower low, we got it. We expected a lower low, we got a higher high. And so that's just essentially how it goes. But then now we've shifted bullish. Again, remember our order flow is the pullback of the swing leg. So it's usually contrary to the swing leg. If the swing leg is bullish, which it now is, then the order flow is going to be the bearish pullback. So what do we see? We see price puts in a low, lower high, and lower low. So the order flow, we know we're in a pullback phase right now because the order flow is putting in lower lows and lower highs. But then what happens? Order flow realigns itself. Order flow realigns itself right here because we have our internal change of character to the upside. Now that right there, again, remember that right there is our indication now that this high is going to be taken out. So we have a conclusion into where price is heading before price is even headed there. And so lo and behold, what we'll see most of the time is price will have its pullback and then it will take out that leg. And what it is our value as a trader is this move right here. But in order to get that move right there, we had to understand this whole picture beforehand, because to know where you're going, you have to know where you're coming from. And so that is essentially understanding our three different types of structure. We have our swing, like so, price pulls back, and then this is the furthest point in the pullback. That becomes our swing low, and then we go put in a higher high, swing high. That's our swing structure. Then we understood that our order flow is the temporary pullback of the swing price that is always opposite to the swing structure. Then we have our order flow realignment, which is when price realigns with the swing structure internally. And then we have our order flow, realign, order flow, swing, order flow realignment. And then we built that whole hypothesis to make money in this move right there. Let's go and take a look at how we can apply this right now to a live chart and get into a profitable position. So pulling up, here we are on the 15-minute time frame, and we're doing it the exact way we do it inside of the Prosperity Academy Inner Circle. So we're on the 15-minute time frame, which is our main time frame. And essentially what it is we're looking at is the 15-minute order flow. So what we're going to do is we're going to start out by mapping out our order flow. So we're starting at this low right here. And again, that should be in red. Starting out at our low, price pulls back, right? Lower high, it's lower than the previous high. Lower low, we put in a new low. Lower high, lower low, lower high, lower low. Shift to the right a little bit. And then what's happened? Price has put in a higher high. So we've gone from, break of structure, lower low, pullback, break of structure, lower low, pullback, break of structure, lower low, to shifting to a bullish, right? We've pulled back, and then what we've had is price has actually put in a higher high, change of character. So the order flow was bearish, lower low, lower high, lower low, lower high, lower low. And then the order flow shifts bullish. So you see that. And then in doing so, again, if you guys remember our pyramid discount, if we take the high to the low, which is where price broke structure, and then we put in our discount and our premium, notice that the furthest point of the pullback right here lands inside of this premium level. And then we pull back, we break structure again. So let's go ahead, take our high right here to our low down here. And again, understand that we have our premium area and we have, of course, our discount area. Notice that the pullback lands inside of the premium area, then price break structure, and then we change character. So again, there we land in premium and we land in premium. And that's the point in which price reverses from. So we've gone from lower low, lower low, lower low, higher high. So again, our understanding and our value discrepancy as a trader is understanding that with this shift right here to go higher high, what we're expecting is what? A pullback. So we can put our fib up in here. And again, we have our discount. And remember, if price is bullish, we want to be longer in discount and bearish, shorten in premium. So we have our premium, prices come from our premium. It's entered into our discount region. So now that price is bullish, we have our edge. Our edge is understanding that price is likely going to go higher. And so already before price is put in that higher high, we're expecting price to continue moving in that direction, right? Essentially giving us our edge before it's happened. So essentially that's how we can use market structure and specifically swing structure to understand our market sentiment, our essential directional bias. So with that in mind, now we're going to look at the 3 different types of structure within this price leg, because a lot of you guys get confused. And if we look at this right here, what we'll see is we have a bunch of these little legs inside of price. And you guys look at this and you guys don't know left from right. You're like, is this the high? Is this the low? Is this a high? Like, what's this? What's that? Is this our swing? How do I know my swing? And so that is exactly what we're sharing with you today. So notice, right? Price is already bearish. And from this point right here, again, same colors apply. I think we went purple for our order flow. What happens is price puts in a high, it pulls back, higher low. Price puts in a higher high, well, higher high, higher low, higher high, higher low, higher high. So understand there that whilst, yes, the swing structure is bearish, as price pulls back into its premium area, price is putting in a series of higher highs inside. We're actually getting a move up, bullish, right? And then what happens? Price changes character in here. Price changes character, change of character in here. And look, at that moment right there, at this moment right here, we can already assume that this low is going to be broken. And so we have from this area of price to this area of price, before it's even happened, we are highly sure that it's going to happen. And that is our value discrepancy as a trader. Of course, you have to add on some other things, which we're going to get into. But that is the point in which we assume that this price is going to be taken out. And lo and behold, it does. So again, moving into green now, which was our order flow realignment. What we have is change of character. We put a low in, it doesn't break structure. We put a low in, order flow realignment, lower low, lower high, and lower low. So notice that the internal shift from bullish to bearish, right? Our order flow and then our order flow realignment, all whilst inside of our swing points, right? Our swing points. And again, what happens if we go back to purple? What happens then? Price puts in a lower low, price pulls back, high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, and higher high. So notice again, our internal order flow begins to be bullish. We begin to put in a series of higher highs and higher lows. The present moment structure for this is bullish. Price is increasing. And this is where a lot of people get confused. They don't know whether they should be longing in here or waiting for a realignment. Now, again, as we did in the example, what you'll see is the moment that price changes character, right, which happens right here, the moment that price changes character, that's our value discrepancy again. We change character, and then we can assume that this low is going to be taken out. So this is the change of character. This is the low. At this moment in price, we assume that from here, we're taking out this. Again, that whole range right there is our value discrepancy. We can expect price to head to here before it's headed there, right? And again, that provides opportunity for us as traders. So we change character, but notice how our order flow realignment, as I mentioned previously, is in this moment the same as our swing. So order flow realignment, we put in the low, right? And that low right there, it realigns, but it's exactly the same as the swing, right? And then price pulls back. And again, this one is a little bit more, discrete. But if we look at it and zoom in, we can see price puts in high, higher low, higher high, higher low, higher high. So even as price pulls back, price is still on a lower time frame, making a series of bullish price action. And then what happens? Price shifts and had its order flow realignment. When the low that puts in the high gets broken here, puts in this low, and then pulls all the way back up to here, and then puts in a new lower low. Again, that's just understanding the present moment structure. Now, although it looks very subjective, it's very simple. Price puts in a high, it pulls back, it goes higher high, it pulls back, it goes higher high again. Then it goes lower low, it pulls back, lower high, it goes again, lower low, right? You see how this works. So then we've put in a break structure externally. Then what happens? If we look, and again, we're going back to order flow because now we've just broken structure in terms of the swing structure. Now we go and put in a high, higher low, higher high. But hold on a minute. We actually go and put in a lower low. Again, this was a news event, hence why the wick was so high and so low, which is something we don't trade. But still, we go and put in a lower low. So at that point, we're thinking that order flow has actually realigned itself prematurely, earlier than it actually has. And again, that's okay. You're never going to get 100% accuracy. We're not aiming for 100% accuracy. We're aiming for over a large enough sample size. Are we net profitable based on the system that we accumulate, tested across multiple different scenarios over a 100, 500, 1,000 trade simulation? Are we net profitable? That doesn't mean you have to be right every time. That's not what we're trying to do. In fact, there is nobody that is right every single time. It doesn't even exist. So essentially, with that said, we do order flow realign, but then very quickly we head back into our internal bullish price action. When we break structure straight away up here, we go higher high, we go higher low, and then we go higher high again. But notice, as of right now, what happens is the order flow and the swing structure are both bullish. So we've just put in a higher high for the swing structure, meaning we've just shifted swing structure. We're no longer bearish, we're now bullish. So what should we be looking for? We should be looking for long positions, because what we're expecting is, even before price puts in a higher low and higher high, is that price is going to go and put in a higher low and higher high, because we understand that our market structure gives us our directional blueprint ahead of time. And in order to understand that, we had to understand first everything that has just happened. We have to understand where we're coming from to understand where we're going to, because that's the only way that we can understand and replicate the blueprint left behind by the institutions that leave the blueprint, that move the market, right? So with that said, we put in our higher high, we're expecting a pullback and higher low, and then a higher high again. That's our value discrepancy. Now we're going to show you how we can capitalize on that information to get into a position. So the first thing you want to do is, after we have a break of structure to the upside, you want to identify an area of interest, a point of interest, an area of demand. Now, if you're first time seeing our channel or this video, I recommend going after this video, taking a look at our supply and demand videos to understand what it is that I'm referring to. But we have our point of interest. A point of interest is simply just an area of demand, an area that we can use by the blueprint that we laid out, our formula, that we can use to identify where there are orders sitting in the market, so that when price gets to that area, it triggers those buy orders and moves price to the upside, all while we were positioned inside of that move. And so imagine market makers, institutions, banks that have all the capital that move the market, because what you have to understand is, in one 15-minute candle, there are billions and billions of dollars being moved up or down. So we and the rest of the retail market are not moving this market, not by any means. And especially even the thousands of traders that are trading prop firms, they're all demo simulation accounts. You're not placing real capital, real liquidity into the live market. So there's something else at play. There's a different entity moving the market. And when you understand that, you'll get one step closer to understanding the concepts of smart money. So with that said, We just want to position ourselves in way with them. It's like, let's take a river, for example. You have a riverbank and that riverbank has a flow, right? It's our job to get into the river and let it take us to wherever the current is. And like a river has a current that flows in one direction, the market has structure that flows in one direction. And that's what we use to get involved and let them take us to where they're going. So we can get our value discrepancy. That's our entire job. That's our entire premise. So we put in a higher high. We're pulling back now, and we have mapped out our area of interest. This is our demand area. Why is this our demand area? Well, we have imbalance, number one. We have essentially our final sell to buy that pushes price higher, number two. So we understand that orders need to be mitigated, and likely orders that weren't filled are going to get filled in this area. And again, we don't have to be correct every single time. In fact, we're never going to be correct every single time. We just need over a large enough period of tries to be net profitable. And that's why risk to reward really comes involved. Let's take a deeper look. So what happens is when price gets into our area of interest, we get an alert and we drop down to our 1 minute time frame. We're understanding fractals. So again, just like our 15-minute is bullish and our internal, again, shows us our external, let's take a look at fractal market structure. Right? If our external looks something like this, right, with this bearish price action, well, let's take a look at fractals. On a lower time frame, market is going to move something like this. Just like the internal and the external, it's pretty similar. Our lower time frame is going to be doing this. And I'll show you what that means, because this is, again, how we get our edge. So we're going to move the internal as red and the external as black. So the internal, the lower time frame, we're going to use the 15-minute and the 1 minute. The 15-minute is black. The 1 minute is red. So our 15-minute structure is bearish, right? We're putting lower lows, lower highs, lower lows. No, yeah, lower lows, lower highs, lower lows. So the 15-minute is bearish. Then the 1 minute, which we're going to put in green, goes like this. We're bearish, lower low, lower high, lower low. We're bullish, higher high. Notice that when the 1 minute shifts bullish, that is when the demand is coming into the market for the 15-minute, so the 15-minute can pull back. Lower, lower high, higher low, higher high, lower low. So now we've had a change of character on the 1 minute time frame. So it's similar concept to internal structure. Our change of character on the 1 minute time frame, now we're assuming that price is going to go lower, and it does. Lower low, lower high, lower low. Then it shifts bullish again, and look what happens when we shift bullish again. The 15-minute is now pulling back. Lower high, no, higher high, higher low, higher high. Then we shift bearish again. Lower low, lower high, lower low, lower high, lower low. So you get what I'm saying right here. So essentially our value discrepancy and how we use fractals is understanding that, okay, price puts in a higher high, higher low, higher high, higher low, higher high, right? On its way back up. But eventually the 1 minute might go higher high again, lower low. In this lower low move, we're able to then position ourselves to go lower, because we understand that when this happens, it's likely that we're now going to put in the 15-minute lower leg. It's just the same as the internal structure, but actually fractalized into timeframes to quantify it. So the same is then rings true. If we are putting a higher high right now, well, when price is pulling back like this, it's putting a high high. In this area of price right now, what do you think the 1 minute time frame is doing? The 1 minute time frame is bearish, right? Because the 15 minutes pulling back. These are likely our swing points for our 1 minute, right? Just how we refer to our internal and external. These are likely our swing points for our 1 minute. So what we're going to do is when price gets into our area of interest, which is now, we're going to drop down to our 1 minute time frame, and we want to read our market structure. We want to read our 1 minute swing structure, because when the 1 minute shifts from bearish to bullish, that is our opportunity to get involved. Because what's happened is there is increased demand more than supply. I mean, there is more buying than selling. So what that confirmation does on that 1 minute time frame in this specific area, we use the 1 minute to confirm our bias. We use the 1 minute to confirm the ideology that this area right here is a good area to trade from. Because when money comes into the market, which we perceive through the 1 minute time frame, it tells us you were right. this is an area of interest. There are orders in here because it's showing us the orders right now. So that's how we use the 1 minute time frame. So essentially what happens is price puts in a lower low, lower high, lower low, higher high, higher low, higher high, change of character, lower low, lower high, lower low. So price is bearish, right? Right now on the 1 minute time frame, price is bearish. Where is the price bearish from? Well, our current swing structure, swing high and low, is our swing high is up here and our swing low is down here. So essentially, let's play price. And what we're going to see happen is price is going to change character. So notice right now what's happened is price has changed character. We've gone from being bearish to now being bullish. We've had a change of character to the upside. So that right there, that one move confirms to us that we were right, that there are buy orders in this area. Why? Because price has increased. All of these candles that have gone up, there is billions and billions of dollars flooding into this market in buy orders. And in theory, if there were going to be price continue going lower, it would have been met with resistance from sellers. Because if there were more people or more institutions or more whatever it is, the algorithm, selling orders at that specific price area, price wouldn't have been able to go higher because you're just met with an imbalance. It's super simple. If there is $5 billion worth of sell orders in a price leg and $100 billion worth of buy orders, well, price is going to very easily go up in price because there is a far more demand than there is supply. It's super, super simple. Now we've got a confirmation that we're going higher. And this right here, again, our value discrepancy, if we go to the higher time frame and we've had our internal shift now from a 1 minute time frame, what we're expecting already is that this high is going to be taken out. So this high right there, that's our target. That is the area in price that we think that price is heading to ahead of time, regardless of anything, because it's just putting a higher high. Now it's putting its higher low, then it's going to put in a new higher high. It's just probable. It's just simple. So when we get into the 1 minute time frame, we've had our confirmation. So now what we're trying to do is get into a position and then get out of the position at this high, because we already know price is heading there and we know price is likely heading there from where we are right now. So our value discrepancy, the money that we make is we get in now and we get out there when we know it's headed there. It's just simple. It's super, super simple. There's no need to overcomplicate this stuff. And again, Einstein said it himself. If you can't explain something simply, you don't really know it. So when you're listening to these gurus online and they're overcomplicating everything and you don't have any idea what they're going on about, they're talking about all these crazy concepts, they don't really know it until you find someone who very easily simplifies it, who knows it like the back of his hand. And so what we're looking for right now in the market is an opportunity to get in. Now, again, we're going to use our concept of supply and demand. We want to find a worthy demand zone of getting in on. What I do and what we do here at the Inner Circle in Prosperity is we refine this area up. So when you can't see a clear-cut area of demand, or we can see a clear-cut area of demand, we have one in here, and we also have at the origin, one in here. So what we're looking for is to go up to a higher time frame and refine that, make it more simple. And what happens is we very quickly disregard this. Our final sell to buy is inside of this 3 minute candle right here. We're going to put our long position at the highs, cover the lows, again, 6 pip stop, just covering the low, making sure you get tagged in with your spread. Where are we targeting? We're just targeting the high, right? All we care about is just making sure that we take out this high. That's the only thing that we know is likely to happen. We don't know where price is heading after that high gets taken out. We don't, and that's okay. We don't need to know. We just need to know that price is taking out that high. So we're happy to take our position off there. Price can run another 50R. It doesn't matter to us. It happens as a trader. You see it all the time, what it could have made. It doesn't matter. Focus on your system. Focus on your plan. Forget what could have been and what should have been. So from there, essentially what you see is price tags us straight in and has this huge rocket of a move straight out. Amazing, amazing sign if you see that. We go straight to break even when this area gets taken out right there. And then we watch price essentially put in structure, right? What happens? Price is put in on the 1 minute time frame. Price is just put in a higher high. higher low, higher high, higher low, higher high. So it's just putting in structure. It's super, super simple. Once you're in the market, now it's really just about letting price play out in its structural nature, like it's going to. Right? Okay, price pulls back. What happens? Price just puts in a higher low, and then price goes and puts in a higher high, hits you full take profit for 7.78 risk to reward. Now, if you made it this far, congratulations. You're clearly the type of person who's serious about their trading journey. And so I want to present the opportunity to come inside of our Inner Circle program, work with me, work with our team to get you where you're going. Because if you've made it this far, you're clearly serious and you're the type of person that we're looking for. Click the link below, book a call with our team, and let's see what areas of your trading needs help with and whether we can be that help for you.